Okay, let's begin our discussion of a new aspect of financial management, which will be called okay, this number 3. Well, let me see. We already discussed, yes, we discussed the asset management ratios. The next group of ratios will be called profitability ratios. Profitability ratios. Okay, the word profitability, you already know. Ekaterina, what is profitability? Yes, this is рентабельность. Profit, прибыль. Okay? So, the first thing we will discuss, let us discuss the definition of profit. So, when we talk about profitability ratios, first we need to define what is profit. In order to understand what the profit is, I suggest we will use 4 key words. 4 key words to describe profit. So, it's going to look like this. Profit. The first key word, well, I'll first draw something and then explain. So this is the picture of profit, okay? So the first word is here, and this word is difference. Difference. The difference. Or the minus. What we use as a minus, in other words, difference, разница. Разница. Okay, the second word here will be, over here, is income. Okay? So this is the second word. The third word will be expenses. So it's difference between income and expenses. And the fourth word will be down below. And this will be over a certain period of time. So difference, income, expenses, time. Okay? So if we're discussing something, some financial indicator that in its nature has the difference between income and expenses over time, this may be a profit. Okay? So we may say that profit is the difference between income and expenses over a certain period of time. Okay, do you have any questions so far about it? I'll give you an example. Okay, let's look at the example. For example, if we go to income statement, here we have 4 kinds of profit. Let's find these 4 key words in this example. For example, gross profit. We can say that gross profit, the 600, is the difference between net sales, this is our income, and cost of goods sold, this is our expenses, over a year. Okay? So, works pretty well. If you go to operating profit and you look at 300 and you say, operating profit is the difference between, and the income here we can use net sales, and the expenses will be cost of goods sold, administrative expenses, and selling expenses. So the sum of cost of goods sold, administrative, and selling expenses over 1 year. So again, difference between income and expenses over a certain period of time. In the same way, you can go to earnings before taxes. The 200 is the difference between net sales and cost of goods sold, administrative expenses, selling expenses, and financial expenses over 1 year. Okay, so let me put it here this way. If we go back, so the income usually is some form. Okay, the income may be sales or some gains. So whatever has a plus to it, it's what comes to us. And expenses may be cost of goods sold, it may be administrative expenses, selling expenses, financial expenses, so everything that has a minus nature to it, like it goes out from us. So income minus expenses over a certain period of time. That's the idea of profit. Okay? Now, let's talk about profitability. Profitability can be defined as, look, I'll put it this way, ability to make profit. Okay? Profitability is the ability to make profit. So, if the company generates income which is bigger than expenses, then this company is able to generate profits. So it's profitable. It's able to generate profits. Okay? So that's the first idea. Second idea about profitability. Profitability is also viewed... by the way, in Russian, this first idea, we use the Russian word «прибыльность». Прибыльность – это как бы компании, то есть это ее способность покрывать свои издержки большими доходами. Вот она прибыльная или убыточная компания, да? So, it's profitable when income is more than expenses, when income is less than expenses, when we have a lot of expenses and small income. So we have loss in this case. Profit and loss. Loss, убыток. So this is loss, this is profit. This is income, this is expenses. But also in Russian there is another word for profitability. Прибыльность, а есть еще рентабельность. Sometimes people say it's the same, but technically it's not the same. Okay? So, ability to make profit is this idea, but profitability as рентабельность, it has a little different color to it. Рентабельность, по-английски также это profitability, is the ratio of profitability. Which means рентабельность is always some kind of profit divided by some kind of base. То есть рентабельность означает соотношение прибыли к чему-либо. Profit to a base. Now, what can be profit in this case? Well, from the income statement we can say it may be gross profit. It may be... Tell me what other three kinds of profits. Gross profit is one. Which? Net profit, it's net profit, operating profit, and one in between, EBIT. Earnings?
Earnings before taxes.
Earnings before taxes. So see, there are 4 kinds of profits already. When we talk about a base can be almost anything. It can be equity. It can be sales. It can be assets. It can be invested capital. Okay? So, and depending what we use here and here, we get different kinds of profitability ratios. Okay? Коэффициенты рентабельности. So, давайте кратко по-русски. Мысль такая, что прибыльность и рентабельность в финансовом менеджменте, это по-русски. Прибыльность – это способность генерировать прибыль, это значит покрывать доходами свои расходы. А рентабельность – это соотношение прибыли с каким-то показателем, то есть это расчетный показатель. То есть там 20% рентабельности, 30%, вот у Никиты там было 50%, 60% рентабельности. Вот когда говорится рентабельность, сразу в голове рисуется картинка дроби. Допустим, оцените рентабельность предприятия, картинка дроби. А если оценить прибыльность, то это доходы минус расходы. Понятно? Вот. А определение прибыли – это разница между доходами и расходами за определенный период. Все, отложилось? Вот. Это такие очень фундаментальные базовые вещи. Если вы их уложите, то когда начнутся всякие названия там, и так далее, ну, в голове будет система, то вам легче будет, вы даже по названию начнете уже чувствовать, какая должна быть формула для расчетов, потому что вы, ну это же вот эта прибыль, тут база, значит, вот так оно должно соотноситься и считается. Okay, let's continue. The first ratio of profitability will be 3.1. 3.1, it is return, Nikita, on your presentation, return on equity. This is the basic ratio, the most common and famous ratio. Nikita was saying it letter by letter, ROE. We can call it ROE. ROE. Okay? So it's a ROE ratio. A ROE is a relationship. Okay. In the numerator, we should have some kind of profit, and the profit is net profit. And the base in this case is equity. Net profit divided by equity. Let's look at our financial statements and find net profit and equity. Well, just to remind you, where do we take net profit and where do we take equity from which financial statements?
Net profit, income statement.
Income statement, equity. Yes, balance sheet. Balance sheet. Okay, let's find it. Now we go up. Net profit is how much? 100. And here's the 4x4 presentation. How much is equity? 600. You see it? It's over here. Okay, so now we go back and put here 100 divided by 600. Zeros crossed out, 1 divided by 6. I need your help with the calculation. 0.166 and so on and so forth, right? So let us transfer it into percentage number. It will be 16.7%. So let's multiply it by 100. This will give us the percentage. Okay, so we say that return on equity for our company is 16.7%. Again, we start thinking, what does that mean? 16.7%. So in this case, if we divide net profit to equity, so our base is equity, and equity is the money provided by shareholders, by the owners of the company. So they invest 100% and they get 16.7%. So the idea, it's like you open a deposit in a bank, and the bank says, okay, we'll give you 18%. And so you get 18% after 1 year. Because here we have 1 year period of analysis, because net profit is for 1 year. So 16.7% is like the interest on your deposit. Okay? So we may say that for each dollar invested in equity or provided by the owners of the business, we generate 0.16 cents of net profit. Okay? So that's the common sense of the ratio. So if I invest $1, I'll get 16 cents. If I invest $1,000, I'll get $166. Okay? So that's the idea. Okay? All right. This is ratio number 1. Ratio number 2, 3.2. This is called return on... no, it's not, we're still not there. Hold on, not return. We will call it profit margin. Profit margin. This is an interesting name with a simple formula. Profit margin. What is the word margin in Russian? Margin, маржа или что-то граница какая-то. То есть у нас есть что-то, а потом пограничный слой. Margin. Ну, вот, допустим, эти поля бумаги, они называются margins. То есть вот эти поля, сверху в печатной области и поля. Это тоже margins называется. И слово маржинальный, он как бы намекает на вот эту, на поля, на то, что вот край. Крайний показатель чего-то. So profit margin is a ratio where we take net profit and divided by sales. Okay? So it's in terms of previous ratio, we can call it return on net return on sales. That's the idea. Net return. Как бы чистый возврат на продажи. Но называется это profit margin. Well, let's find the numbers for it. How much is net profit? 100. Sales, where do we find sales? In income statement. So let's find it. How much is net sales? 1,000. Oh. 100 divided by 1,000. 0.1 or 10%. Do you agree? Yes. So what does that mean? In this case, the base is sales. So we may think, using common sense, that, okay, I sell this much, this is my 100%, I sell this much goods, and out of this much goods, I get 10% in profits. So from each sold unit of goods, 10% is my margin. Okay, that's why it's called profit margin. So in the cost, in the price of our goods, how much is profit? So if I sell it for 1,000, 100 will come as my profit margin. If I sell it for 110 will be my profit margin. Okay, so this picture of, like, this is the price. Let's say this is the price. No, like this. This is the price. And this is your profit. Okay? So that's why it's called profit margin. Because it's like on top. Profit margin. So all you need to remember that it is connected with sales. Sales. Profit margin is net profit over sales. Again, here I can say for each dollar generated in sales, I earn 10 cents. 10 cents in net profit. Okay? Each dollar in sales earns 10 cents in net profit. That's my profit margin. So does it make sense to you? Good. Next ratio that we will discuss will be operating income to sales, 3.3. 3.3, operating income to sales. Now I want you to think about it. Here's the name. Guess what will be the formula for operating income to sales? What should be divided by what? Any guesses?
Net profit?
Look, operating income to sales.
Operating profit?
Operating profit divided by sales. Yes. See, the ratio itself starts telling you. Operating income. Там у нас оно не дано. Ну, сейчас я... I have one guess, but I want to check it first. Okay. Well, I guess we can use, let's do this. Let's call it this way. I think it will be fine. Let's call it ROS, return on sales. Return on sales. Return on sales. Or operating income to sales. Okay. So the idea here is that we relate not net profit, but operating profit. That's the only difference. Profit margin is net profit by sales. Return on sales is operating profit by sales. Okay? So how much is it going to be in our case? We know sales is 1,000. Where do we look up the operating profit? Income statement. And here is income statement. So let's look. Operating profit is, yes, Evelina, you're right, it's 300. So we put here the 300. And that gives us 0.3, right? 3 by 10, 0.3, or 30%. So if here we had the net profit in the sales, so in this case, we will look at operating profit. So, well, the operating profit, let's make it this way. So this is operating profit margin, okay? So in our sales, this is our sales, this is our operating profit. So 30%. Again, for each dollar in sales earns 30 cents in operating profit. Okay, so each $1 in sales earns 30 cents in operating profit, or EBIT. EBIT. Yeah, that's, by the way, I can write down. So operating profit is the same as EBIT. If you forgot, just a reminder, look, operating profit, what's the second name for it? Earnings before interest and taxes. So, coming back, this was our third ratio. Number 4, 3.4. 3.4. Return on assets. Return on assets. Return on assets. We will call it ROA. ROA. Return on assets. Well, guess. What should be the formula? What should be the base in this formula? Nikita, what do you think should be the base under? Assets. Of course, assets. So what should be the numerator? Here there is a trick. So you should think two things, right? What can you think of? What should be in the numerator? Net profit or operating profit? Okay, in this case, in return on assets, we will use net profit. Net profit. So let's guess. Let's find out. Net profit is a given. Remember, it's 100. Assets should come from which statement? Yes, balance sheet. This is income statement. Let's go to the balance sheet and find that our assets are, can you see the total assets? Now you see, right? It's 1,100 or 1,100. Remember math that we talked about. So 1,100. So this crosses out. Now I need help. 1 by 11. 0.91 or 9.1%. Okay? Okay, so no, 0.091 probably. Right? I think here we should have. Okay? So 1 divided by 11 should be less than 0.1. Okay? 9.1%. Okay? So now if you use the same picture, here we have assets. This is our base, 100%. And in this 100%, there is itsy bitsy this is our net profit in comparison to our total assets. Itsy bitsy little. There is a song, the itsy bitsy spider went up the water spout. Down came the rain and washed the spider out. Itsy bitsy little one. Okay. So each dollar, so now in this case, our each $1 in total assets generates 9.1 cents in net profit. Small one. Okay? So this is how we understand the formula, use the numbers, kind of pull it from different financial statements, and then understand, okay, 9.1, what is it? And the next is 3.5. That's the tricky one. The tricky, такой хитрый коэффициент, 3.5. Return on invested capital. Return on invested capital. Return on invested capital. Let's put together the abbreviation. It will be what? ROIC. Return on invested capital. Or ROIC. Okay? ROIC. In this case, we understand that the base will be our invested capital. Now the question is, what kind of profit will be here? Okay, so in this case, there are two approaches how the ROIC can be calculated. We will try to consider both. I think we still have time. Yes, we have about 15 minutes. So the first approach uses the following logic. They say that we need to compare our invested capital to what is called NOPAT, another abbreviation, NOPAT. Okay? So what is NOPAT? The NOPAT stands for net operating profit after taxes. Net operating profit after taxes. Okay? Net operating profit after taxes. What does that mean? Okay? So it means the following. If you remember how we calculate, let's refresh how we calculate income in the income statement, operating profit. Look, we take net sales, subtract cost of goods sold, get the gross profit, subtract the administrative expenses and selling expenses, and there we get the operating profit. Usually after that, from the operating profit, we should subtract financial expenses. But NOPAT has the idea of skipping not subtracting the financial expenses, but only subtracting taxes. So you keep the operating profit and only subtract the taxes. So it's going to look like this over here. So if, let's say, we have net sales minus cost of goods sold, that gives us the gross profit. Then we subtract administrative expenses and selling expenses. We get the operating profit. This is our gross profit. But then instead of going to subtracting financial expenses and getting the EBIT, we jump over this and we just subtract the taxes. And we get NOPAT. So technically, if you take the net profit and add to it the financial expenses, you will get the NOPAT. So it's like the operating profit, well, think about it technically. This was 300, this was 100, the net profit. Yeah, well, let me show it here, sorry, maybe. So, see, you skip the 100 of financial expenses and only subtract the taxes. So 300 minus 100 will be the NOPAT here, NOPAT, will be operating profit minus taxes. So it's the 300 minus 100. And it will be 200. The NOPAT will be 200. Okay? But if you take NOPAT and calculate it as net profit plus financial expenses, you get the same 100 plus 100 gives you the 200. Okay? Now you see? It's just a mathematical trick. The idea, what you need to keep in mind, that NOPAT crosses out the financial expenses. So it's, you go to the operating profit and then skip and subtract the taxes without subtracting the financial expenses. Okay, so that's the idea. Okay, so I'm not gonna keep it here. We don't need it. Now you already know what it is. So net operating profit, it's, let's use the basic formula, it's operating profit minus taxes. Okay? So we're going to use this approach. So this is NOPAT. Now, but the question is, what do we mean by invested capital? So invested capital, let me write it down here. Invested capital. By the way, let's write down here, it's 300 minus, hold on. No, one more time. Let's move it aside a little bit. 300 minus 100 equals to 200. So that's the number that we might need to remember. So this is our NOPAT. It's 200. Well, let's talk about the invested capital. The idea of invested capital, it's something that is provided by invested by stockholders and creditors, banks, financial institutions. So, in other words, who invested money in you and wants to take it back? So, out of this, we don't use the money like the salaries payable, taxes payable, all these small liabilities that we have pretty much in this section. Okay, equity is invested, long-term liabilities invested, short-term debt invested because there is some interest over it, but accounts payable, taxes payable, salaries payable, rent payable, dividends payable, utilities payable, this is not the investment part. It's more operating liabilities. It's like for us to live. But the part above it is the invested section. So we say that we will use the following formula for invested capital. It is our equity plus debt. Okay? Except for one thing. We should subtract from equity and debt. This is another trick. Net operating assets. This is a new idea for you. So net operating assets. So net operating assets, what's the idea here? Like we have the operating liabilities, like I said, salaries payable, I named accounts payable, taxes payable. So these operating liabilities. In the same case, in the assets, we have net operating assets, which are here. I'll highlight it. This is our net operating assets. It's the liquid part of our assets that is connected with money itself. Net operating assets, it's whatever we need at hand to buy, sell things. So it's net operating assets. So it's short-term investments and cash. And here you may catch this interesting idea that invested capital means we use kind of the equity and debt. We don't use it for investing in money. We use it in investing into our land, plant, equipment, inventories. So we try to invest it into the big assets. Okay? So we use the purple and the green part on the like equity and debt to invest it into non-current assets and current assets except the net operating assets. So that's the idea of invested capital. Okay? So I will go back a little. So here I will write down that this is cash and short-term investments. And let's find out what we have for invested capital. Our equity is how much? Remember we talked about it? Yes, 600. Now, with our debt, we need to clarify here. Okay, let's go and see what is part of our debt. Our debt includes the long-term debt, the 200. Yes, the 200. See, 150 plus 50, and everything but accounts payable, another 150. So 150 plus 50 plus 150 gives us 350. Okay, so it's this part. And it's 350. This is our equity plus debt. Agree? Now let's look at the at this part. This part is 200. Okay? So net operating assets is this part. 200. You see? So we go and put it here. So this is 350, this is 200. That gives us how much? 750. I guess that's what we have, right? 600 plus 350, 950 minus 200, 750. Okay, so our invested capital is 750. So now we can calculate the return on invested capital in this case. So, we put here that ROIC 1 equals the 200 divided by 750. So how much is that? 4 by 15. Oh, no, 4 by 25. How much is that? 0.27, like this. Yes? Okay. So it is the 27% return on invested capital. So that's the idea. If I am the investor, it doesn't matter whether I'm a creditor or a stockholder. So I see that this ratio tells me that this company, the invested capital is 750, but the NOPAT is this kind of our production potential minus our taxes, which is operating profit minus taxes, is 200. So this is the 27% of operating profitability. This is our operating profitability of business. So let's highlight it. That's the first way of calculating the return on equity. The other way of calculating, and that's going to be number two. We use the same invested capital, but here we take the net profit and subtract the dividends. Net profit minus dividends gives us this ratio. Okay? Excuse me.
Чистая прибыль это разве не уже с вычетом
Нет.
дивидендов?
У нас, look, net profit is calculated this way. It's minus taxes. We take the financial expenses. Financial expenses, they include interest payments. Over here, financial losses. It's our interest payments. So whatever we pay here, all these percentages, see, bank loans, car loans, long-term bonds, notes, these percentages are included, but dividends, they are here, and they're not included. So the dividends are subtracted after net profit. So here we usually subtract the preferred dividends, and then we also subtract the common dividends. Okay, so they are paid from the net profit. Okay, so that's the idea. So you subtract the dividends from the net profit, which also diminishes your potential profitability. And usually these dividends are hidden over here in the balance sheet. We have dividends payable, see down below in accounts payable, there is to suppliers, taxes, salaries, rent, interest payable, dividends payable. So if we collect all the dividends paid during the year, this is where we can get this number. Unfortunately, in our calculation, we don't have it right now, but maybe I can get it from somewhere else. Let me see. Where can I get it? I don't. Well, let's just give it a number. Let's say that our stockholders want to earn, as far as dividends, maybe 7% on their stock. Yeah, let's make it like 7%. If we have, for example, common stocks and preferred stocks, 100 plus 50, let's do it here. So 150. Let's take 7% of that. How much is it going to be? 7% of 150. 10.5. Well, let's make it the 10.5. Well, let's make it 11. Let's make it bigger. So approximately 11, and we will use this number for our dividends. Where here? Let's say it's 11. So in this case, 100 minus 11 divided by invested capital, which is 750, will give us 89 divided by 750. How much is it going to be? 0.12. Or 12%. Okay? So this is another approach. These are two different ways of looking at return on invested capital. In the first approach, the focus is on, okay, this is our operating potential of the company. This is how much stocks and debt we used to invest into the company, and they generated so much operating profit after taxes. So it's 27% profitability. In the second approach, it's more like, okay, they paid all the obligations and the dividends they paid, so what is left? Well, 89. The invested capital is 750. So let's just think this is more like a reserved and pessimistic way of looking at return on invested capital. It's 12%. It's not so much the number, but the dynamics. Is it going up? Is it stabilizing? Or is it going down? So if you use the second approach, just watch it how it goes over time. And you can watch it different companies. So this will be your mindset, how you look at it. If you use the first approach, you have a little bit different mindset, but you'll also be watching growing, keeping, or declining. So that's pretty much it. Well, that concludes our discussion on profitability ratios. And one more thought, and I'll let you go. Why this ratio is important? Usually this ratio is important after you calculate it. You need to compare it not only to other companies, but you also need to compare it to what is called the weighted average cost of capital. Слышали когда-нибудь средневзвешенная стоимость капитала? Понятие. WACC, так называемый. So, usually you compare it to, where is that? So ROIC should be compared to WACC, weighted average cost of capital. And if it's more than WACC, that's a smile. If it's less than WACC, that's a sad face. If we have time, maybe next time we'll talk about it. I'll think what we can discuss about WACC, but it's an interesting concept. Okay, round up here, and I'll see you next week.